Morning, everybody. I'm going to give us a couple of minutes to allow everybody to get logged on, and then we'll go ahead and start. Okay, it is 10:01, and we will call the June 13th, 2024 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting from May 9th, 2024. Have a motion and a second. Please record your vote. Item is approved. Item number 3 is presentations from a couple of our investment managers. First up is Western Asset Management. Jason, you want to give us a little prelude?
Good morning, everyone.
Good morning.
So just as we continue to just have managers in for regular reviews, today we have 2 of your fixed income managers. Next month we'll have the global bond manager. Effectively, your fixed income allocation of 25% target today. We're a little bit underweight. We moved from 20 to 25% at the beginning of the year on a target basis when we took long-short equity to 0. Long-short equity is you're redeeming from that, and it's going to take some time to get that capital back. As it comes back, it will be allocated into these fixed income strategies. Western Asset Management, the first manager up today, is a Core Plus strategy. So they have, I'll let them go into it, some flexibility outside of just core investment grade. They've been a long-time manager of yours. That's the largest portion of your fixed income allocation. It represents 10% of the 25 on a target basis. And then secondly is one of your newer managers, PGIM. They are an unconstrained fixed income or absolute return strategy, a little less their ability, particularly in the environment we've just come out of for the last decade, where we had very low to expected rising rates. The ability to navigate that and move duration around a little bit has been very helpful. So they complement one another and do a little bit different things. So with that, I'll turn it over to the folks from Western.
Okay. One request, could you pull the mic up a little bit? We're having a hard time hearing.
Sure. Is that good? Can you hear me?
Yep.
Thanks, Jason. Appreciate that. Appreciate the introduction, and thank you all for taking the time this morning and inviting us to participate in your meeting. As you all know, the Employee Retirement System has been a long-standing client of Western Asset since December 2002, and we very much appreciate this long-standing relationship. My name is Charlie Colby. I lead our public and multi-employer business for Western Asset, and I'm a new face to you all. Typically, my colleague Kevin Gore covers you, and Kevin sends his regards. He had another client conflict today, and so that's a beauty of the model is we can all kind of step in and cover for each other when needed. It is a team-based approach here, and Travis might get into that a little bit. I'll start just quickly on page 5 of the presentation. Western Asset, we're a fixed income only asset manager. We have portfolios across the fixed income landscape and a global footprint from an office perspective. We are a wholly owned subsidiary of Franklin Templeton, and we've been doing this for 50 years. As of the end of March of this year. Assets stand at $385 billion. And experiencing some positive net flows in our long-term assets and some modest outflows in our liquidity business. But I do think there's been some positive trends in the business. Certainly, with the reset in yields that you've seen over the past few years, with the Fed raising rates pretty meaningfully, it's brought value back into fixed income, and that's certainly a trend that we're seeing from our clients, and certainly I think you all are looking to take advantage of over the near term with the reallocation that Jason noted. And where we are seeing client interest, certainly in the broad market space within our public fund clients over the course of the year, we have seen positive net inflows from reallocations. We're seeing a decent amount of search activity. And I think that's a recognition of the value that fixed income provides today that maybe it hadn't provided for the last 10 or 15 years after the global financial crisis. I'm joined today by my colleague, Travis Carr. Travis is a senior product specialist at Western. He focuses on our broad market suite of portfolios where the Core Plus strategy is situated. So Travis is going to come up here. He's going to try to talk a little bit about the team, process, and then how the portfolio is positioned and performed in the market environment. We'll try to keep the comments around 20 minutes. Certainly happy to take any questions that you all may have. And then the last item that I would note, we did have one personnel turnover that I would like, I need to flag. There was a named portfolio manager on your strategy, a gentleman by the name of John Bellows. He left the firm and he came off the strategy effective May 1st. So this is relatively new. And when you do have portfolio management turnover, that's something we always want to flag for our clients. I would say, just briefly on how Western approaches portfolios, it is a team-based approach. We have a deep team of broad market portfolio managers that is focused on all of our core and core plus portfolios, 10 portfolio managers, with a subset of those named as the portfolio managers that focus on your portfolio. I think, John, it's always, you're always sad to see a colleague leave, certainly, but we have a lot of confidence in the team that remains in place, led by our co-CIO, Ken Leach, and the head of broad markets, Mark Lindblom. So with that, I'll turn.
Just to highlight that, if you could go to page 13 and just talk about the experience of that.
Yeah.
Portfolio management team.
Absolutely. You can see that on page 13, the 10 portfolio managers that I highlighted listed on the left-hand side of your page, and the two individuals that I mentioned, Ken Leach, who's our co-CIO. He's been with the firm since 1991. Really is an investment thought leader, highly regarded in the industry. Mark Lindblom leads our U.S. broad market team. Then as far as the other named portfolio managers on your strategy specifically, Fred Markey, Julian Skolnick, Nick Mastriani, and Amit Chopra. So these, I would say it is a team-based approach. One thing about Western Assets is certainly not a star system. Our strategies, and Travis will get into a little bit, but are set by our U.S. Broad Market Committee, and those should be implemented consistently across all the portfolios. So one thing, a dynamic you don't have is, these portfolio managers looking at their group of portfolios and trying to outcompete the person that's sitting next to them. They really are trying to all implement those ideas consistently across all of our strategies, and pulling in the same direction from that perspective. So with that, I'll turn it over to Travis. He can get a little bit more into the market recently, how we're positioned, how we're reacting to it, and certainly happy to take any questions the group may have.
Perfect.
Morning, everyone. We can start on page 16. I'm going to talk a bit about performance, what's been working, what hasn't been working, how we're positioned, and why, and really kind of tie that into our outlook. So you can see performance there. Year-to-date's been a bit volatile. Really kind of continue the volatility we've seen the last couple of years. You think about last year, it was really, the narrative really changed a lot. At the beginning of the year, there was a lot of concern about maybe recession risk, because when the Fed had historically raised rates as aggressively as they did in a short period of time, that has historically led to recession. I think those fears exacerbated a little bit back in March and April when we had some of the banking issues, some of the regional banks fail. Yields fell. There was a concern maybe the Fed's going to have to cut rates. But then those fears really abated in the summer and the fall of last year when it was fairly resilient growth. We had third quarter GDP almost 5%. Job market was very resilient. Spending was very resilient. And there was this strong kind of growth narrative. And the concern back then was, is the Fed going to have to keep raising rates to keep kind of growth and inflation in check? 10-year Treasury yields went above 5%. So a pretty negative, environment for fixed income. You think about where we were kind of in mid-October of last year. Last couple of months of last year, though, the narrative changed a bit. Growth was still positive, but moderating. Job market was still positive, but moderating. And most importantly, inflation was really starting to come down. That disinflation process was really in place. So you had a really good rally in the last couple of months of last year, kind of an everything rally, because it was about inflation coming down, the Fed basically saying they're done raising rates. So you had equities rally, treasuries, credit, kind of a really strong environment. That environment that optimism came into this year, but we had a bit of a stall in the inflation progress. The first few months of this year, inflation came in a little bit higher than expected. And then the thought is, maybe the Fed isn't going to be able to cut interest rates. And a lot of those expectations of rate cuts was being pulled out of the market, and you saw yields rise to start the year, really through April, when Treasury yields backed up about 80 basis points. What's happened more recent in the last couple of months is a little better picture on the inflation front. We got the April inflation print, and then just yesterday, we got another inflation measure that came in below expectations. Job market is still positive, but it appears to be becoming better in balance. It appears to be cooling a bit. Job growth is still positive, but moderating. And I think you're seeing things that are showing the growth narrative is also moderating. First quarter GDP came in at 1.6, was then notched down to 1.3. So kind of a slowdown of what the strong growth we saw last year. And really, what our expectation is that we believe this disinflation process will continue. It's going to take some time to reach the Fed's target, but we think that path is certainly in place. And again, we think that growth narrative is going to moderate compared to last year. We don't expect a recession. That's not our base case view. But we do expect a bit of a slowdown compared to last year. So in that kind of environment where growth is moderating, inflation is coming down, that's an environment we think yields will edge lower over time, and the Fed will be in a position to cut rates. So you see certainly 3-year, 5-year performance here is a bit challenged. That really shows kind of what happened in 2022, the impact of yields rising materially. Longer term performance is still certainly in a good position. On page 17, kind of show a little bit of a historical perspective. If you look at the snapshot of your 3-year and 5-year performance going back 1 year, 2 year, 3 years, these kind of rolling 3-year, 5-year returns. Again, right now it's a bit of a challenging picture given the environment we're coming out of, but again, that longer term consistent performance we think is certainly in place, and we certainly think we can get back to those positive 3-year and 5-year performance numbers as well. As far as the attribution on page 18, what worked in your portfolio and what didn't. So we have the year-to-date here in blue and the 1 year, so May to May in green. And on the left-hand side of the chart, you see kind of the interest rate positioning, duration and yield curve positioning. That has been a detractor. We had a little bit longer duration or interest rate exposure versus the benchmark. That's been a headwind to performance. But on the right-hand side of the page, you see all of the kind of non-treasury or spread sectors. Those have all outperformed and delivered positive excess returns because, again, this last period has been about resilient growth. And if you can say the near-term recession risk, kind of move that off the table a bit, risk assets are doing quite well. So all of these spread sectors or risk sectors in your portfolio have generated positive excess returns over this period. Areas like agency mortgages, these are the government-guaranteed mortgage-backed securities, structured products, and non-agency residential and commercial mortgages. Corporate credit has done very well, investment grade and high yield corporate credit, and even areas like emerging markets. So really positive kind of risk environment that has generated good returns, while the interest rate positioning has been a bit of a headwind. On page 19, one of the things we have kind of refocused on is recognizing that the environment in 22 was extremely volatile, and the environment didn't play out exactly the way that we thought, and so we're kind of refocusing our efforts on looking at alternative scenarios. What's our base case view? But then also, what are some other scenarios that could play out? These are not tail risks. These are not 1% probabilities. These are kind of plausible but non-base case scenarios. So our team looks at what we think will happen in our base case view, positive growth but moderating, disinflation continuing, and yields falling over time. But then we also want to look at what are some other scenarios that could play out. I said we've kind of taken that near-term recession risk off the table, but we don't think it's a zero probability. I think you are seeing some cracks in areas like consumer spending. You're seeing credit card balances rising, delinquencies are rising, and I think you're seeing a slowdown in spending and a little bit of a weakening in manufacturing. So I want to be thoughtful about that potential slowdown or recession scenario, and how are we positioned, and how do we think we would perform relative to the benchmark in that kind of scenario. The other scenario really you want to be thinking of, and we're thinking of a lot, is that higher interest rate scenario, or kind of a stickier inflation and higher rates for longer. I think the recession scenario was more prevalent last year. This higher rates, stickier inflation is kind of the more prevalent potential other scenario today. Maybe rates back up a little bit, and you have some weakening in some areas and some spread sectors. So we're being very thoughtful about how we're positioned, not only in our base case, but also looking at some other potential scenarios. How would our relative performance be in that scenario, and is that acceptable given the mandate that we manage for you? As far as positioning, on page 20, on the left-hand side of the page, we show how we're positioned in different sectors compared to the benchmark. Your portfolio there is in blue and the benchmark in orange. Really, the theme that we've been expressing the last year or so has been, let's move up in credit quality. Yields are certainly attractive. You don't have to stretch too much to get a pretty attractive return. Also, when you look at areas like below investment grade or high yield credit, and this is the case in investment grade credit as well, the additional yield that you're getting over treasuries, or that credit spread, is fairly tight, because the environment's been very positive for risk assets. It's tight when you look at kind of the historical range. It's on the tighter end of that range. That's the bad news. The good news is we think they're tight for a good reason. Fundamentals are very good in corporate credit. The economic environment is positive, but want to be thoughtful about valuations, and so we have been reducing some of that below investment grade areas like high yield and bank loans, because that additional yield is fairly small that you're getting versus treasuries, and thinking about that potential recession scenario. If you have that environment, you're going to see risk assets weaken, and so we've reduced some of that exposure. So we want to be a little bit higher in credit quality, areas like investment grade credit, higher quality corporate issuers, areas like agency mortgages, the government guaranteed mortgage-backed securities. Those are areas that we like, very high quality, very liquid. You don't expect a lot of capital appreciation there or spread tightening, but you just like the carry. You like that coupon that you're earning, and you like that high quality and liquidity. Then the question is, where do we still see value? I think there's two main areas. One is structured products. I mentioned the non-government guaranteed mortgage-backed securities, residential, and certainly commercial. We all know there's a lot of issues in commercial real estate. It's primarily focused in the office space. Most of the other sectors in commercial real estate are doing quite well. If you look at apartment buildings, anything industrial, warehouse, fulfillment, data centers, certainly doing well. Retail is a mixed picture. You have to be thoughtful about what kind of retail exposure, and as well as hotels are also kind of a mixed picture. But the bottom line is, it's a very idiosyncratic market. Every city is different, every building is different. So our team is really focusing on picking individual properties that they like, because when there's a lot of bad news in a market like commercial real estate, that's sometimes where you find very good opportunities. So we're looking for opportunities where we think the market's been oversold. The other area that we continue to like is emerging markets. They had a very good year last year. We continue to see a very positive outlook in emerging markets. A lot of these economies are growing at a fairly fast rate. They have better demographic pictures generally, younger workforces, less debt to GDP. And in many cases, their central banks raised rates ahead of the US and developed markets, got ahead of inflation, and are now in a position to start lowering rates. So we like the growth outlook in some of these markets. So being very thoughtful about what sectors we're positioned in, and really rotating it around where we see the best opportunities.
Charlie, just sticking with this page, this strategy is Core Plus, and just to frame it for the board, you have a core index strategy and this Core Plus strategy, which can go up to 20%.
Yeah, so we have, if you think about below investment grade or high yield, that's going to be the high yield credit and bank loans. So that's about 4.5%. And I'll tell you, that's the lowest we've been in high yield in probably the last 10 years. And it is reflective of the fact that we're being a bit more cautious about high yield. Then if you, the non-dollar is kind of the main other kind of plus sector. And right there, that's going to be EM local currency, where we're investing in emerging market bonds that are denominated in their local currency. And that's roughly about 2%. So we're only using about 6.5% of that plus sector right now. Yep. I'll just touch on our rate positioning briefly. I want to be mindful of our time. On the right-hand side of page 20, you can see at the bottom of the page, we are still long duration. We have a little bit more interest rate exposure than the benchmark. And that's really there for two reasons. In our base case view, we do see an environment where yields edge lower over time. Again, the data recently has been more Fed-friendly, more bond-friendly, and treasuries have been rallying a bit, and you're seeing those yields start to come down. But importantly, in that non-base case, that recession scenario, that's an environment where risk assets are going to weaken, and so that's really when you want that extra duration to mute that downside volatility. You certainly didn't want duration or interest rate exposure in 2022 when rates were rising. The question is now, if the Fed is done raising rates and can potentially start cutting rates the latter half of this year, and inflation is coming down, maybe that is the time you want to have some extra duration. So that's there as in our base case view, but also importantly, in that recession scenario where you want to have that to kind of mute that downside volatility. As far as where we're positioned along the yield curve, if you looked at this a year ago, we had more exposure at the long end of the curve, 20-year and 30-year treasuries, and underweight to the front end. That worked when the curve was flattening. You might have heard the yield curve was flat or got very inverted, where short-term rates were much higher than long-term. Now the question is, if the Fed is done raising rates and they start to cut rates, what's going to happen with the yield curve? And we expect it to steepen, meaning the front end should rally more than the back end. So we've been trimming some of our overweight to the back end of the yield curve, putting it more in the front end, positioning ourselves for that eventual turn in monetary policy, and it should benefit when the Fed starts to cut rates. So we look at performance going forward, where we expect to see positive excess returns. I think you start with that yield advantage we have in the portfolio over the benchmark, about 50 basis points. If nothing changes, that's the return that you should earn. We also expect some benefit from some of these other spread sectors that we think are cheap, like structured product and EM. You could see those areas start to rally. And then hopefully what we expect is that duration and curve positioning should start to benefit and deliver positive excess returns when yields edge lower and the Fed is in a position to cut rates. I'll stop there and see if there's any questions.
I've got a question on the duration. I'm not sure I've got my right approach here on how to interpret the graph here that you've got. So like when it's got the 1.59 for the 5-year duration, is that you're over the duration by 1.5? Like in essence, I guess help me understand what the numbers mean on those.
Sure.
Yeah.
So in the blue lines, that's the portfolio we manage for you. And then the orange is the benchmark. So the aggregate index that we manage against, that's showing you how much duration is that point of the yield curve. So for instance, in the 5-year, we have 1.59 years of duration at the 5-year part of the curve, a little bit more than the benchmark, which has 1.41 years. So the overweight there is about 18 basis points compared to the benchmark that we manage against.
And I guess what I'm struggling with, if it's a 5-year duration, how does 1.59 correlate with the 5 years?
Contribution to duration.
Yeah.
The total duration.
Yeah. So the total duration of the portfolio in the benchmark is at the bottom. Each bond has, depending on when the timing of those cash flows come in, that's when the contribution to different points of the yield curve, you'll see those, they call it, what's the key rate duration? How much duration at certain points of the yield curve? So it's how much of the total duration is being contributed at the 5-year part of the curve, as opposed to, let's say, the 30-year part of the curve. So it just depends where the timing of those cash flows come out in the portfolio as well as compared to the benchmark.
I guess I'm still.
So it's a weight times that duration, the weight of those securities in the portfolio multiplied by that duration.
Okay.
To get a contribution to the total duration.
So if we have, let's say, we buy a 30-year treasury bond, you're going to see much more of that key rate duration at the 20-year and 30-year part of that curve. If we're buying a treasury bill, you're going to see that duration show up at the very front end, or 6-month or 2-year
Right.
key rate duration.
Any other questions? Okay. Well, thank you all very much.
Thanks for your time. Appreciate it.
Okay, next up we have PGIM. Good morning.
Good morning, everyone. Thank you for inviting us here to present, to provide an update of your absolute return bond fund that we manage on your behalf. I'm Kate Strengfeld. I'm a member of the client-facing team at PGIM Fixed Income, and I work closely with our Oklahoma-based clients. Rich Piccirillo, he is the co-head of our multi-sector team, and he's responsible for managing, along with his large team, your absolute return bond fund. I thought I would provide a brief update on PGIM Fixed Income. If we can move to slide 4 of the presentation. It's been about 4 years now since we've had the opportunity to manage the portfolio on your behalf. We funded the portfolio in August of 2020, and we've had strong performance, and we appreciate the continued trust and confidence in PGIM Fixed Income. So if we take a look at slide 4, as a quick reminder, PGIM Fixed Income is the wholly owned asset manager of Prudential Financial, the insurance company, and we are a large and well-resourced fixed income asset manager. If you look at the pie chart in the middle, you'll see we manage across all sectors of fixed income, which is particularly important for this multi-sector type of portfolio. We also have a very large credit research team. Research is a career at PGIM Fixed Income, and our analysts work alongside the portfolio managers to build your portfolio bond by bond from the bottom up, which Rich will talk about a little bit as well. I'd like to point out the pie chart on the top right. You'll see we manage more money for third-party institutional clients like yourself than we do for our insurance company parent, which are the proprietary assets listed there. And to be sure, it's a same process that manages all these assets, so there is no conflict of interest. If there are no questions on the firm, I'd like to hand it over to Rich to talk about performance, positioning, outlook.
Any questions? Okay, we can proceed.
Good morning.
Can you pull the mic up a little bit? We're having an issue with our speakers up here, and
I think that's
Closer
about
you
as
can get to that, the
close
better.
as I can get.
That's perfect.
How's that good? Great. Good morning. Nice meeting everyone. Thanks for having us. So I think I'll start with page 5, just to sort of overview the team. So like many other of these large organizations, we do have a team approach. I am head of multi-sector with a couple of my coworkers you see right up top. I'm sorry, my name is Rich Piccirillo, and I do work along with others. The section just below it are all of the individuals that are dedicated to portfolio construction in multi-sector portfolios. And so they're allocating the risk to the different sectors of the fixed income market. And the individuals down below are the sector specialists who are buying the bonds in their respective sectors. There are many more that are contributing to this effort, but these are the senior managers in the organization. And your portfolio fits in right along with that. And so with that, and please stop me at any time for questions, just a little bit of a market backdrop. So I had the advantage of just listening to the last presentation, so I'll try not to bore you. I'm sure the only thing worse than a fixed income presentation is 2 fixed income presentations. But if you look at page 8, so it was mentioned, rates are higher. This did not affect this portfolio as much because the last presentation you had was an aggregate index, sort of a representation of the full fixed income market. It has bonds from 1 year to 30 years. The benchmark that we're managing to is 3-month treasury bills, so it doesn't have very much duration at all. So you'll see the returns are higher just because it's shorter. and did not get disadvantaged from those rising rates. In general, though, fixed income returns have not been that good because if you see in the far right-hand column, what you just saw was through May. This is through April, not quite as updated. But rates are higher, and you'll see that on the far right-hand. Fed funds had already done their hiking, so 3-month had not risen as much, but you'll see the intermediate part of the curve, you're coming up close to 100 basis points higher in rates. And of course, that hurts fixed income returns. And so that was a negative and a drag on fixed income portfolios. But there was an offsetting positive. So if you just go one more page, page 9. As was mentioned, equities, credit risk in general did well. And so the excess returns of all those different sectors that have credit risk, like mortgages, like corporates, like high yield, like emerging markets, did quite well. And those are the excess returns you see in the far right-hand column. And that did help this portfolio and helped it to outperform that risk-free benchmark. So we're invested, the benchmark is 3-month T-bills, but within your guidelines, we can invest in many different fixed income sectors that carry risk. And since we're invested in those sectors, the portfolio outperformed the benchmark. And you'll see that, lower quality, below investment grade, or something like emerging market high yield did fantastic, over 600 basis points. So there was a considerable rally. And that fits in with better growth expectations globally. The one sector you'll see as negative is U.S. agency mortgages. And so that had a negative excess return. And really the main dynamic there, besides interest rate volatility always hurts mortgage securities, is that you had the government, the Fed, buying all these mortgages that was part of their quantitative easing program. And then it switched to quantitative tightening. It wanted to reduce the stat. That buyer in the marketplace was taken away. And so these spreads widened. We believe that they went from an instrument that was very rich or unfavorable, unattractive purchase to something that was attractive. And so we have increased our allocation there. And so excess returns in credit have done well, and that's offset the negative from any sort of duration that might be in a portfolio. So with that backdrop, if you look at page 12, as I was saying, you'll see higher returns here, at least for the year to date, just because there's no duration in the portfolio. And you were able to take advantage of a benchmark that actually had a positive excess return, if you're getting that carry and income from the short part of the curve, and a portfolio that had credit instruments, so it actually outperformed over 3%. So excess return of 160 year to date. And to break that down a little bit, looking at page 13, and I just might add that all these excess returns are risk adjusted. And what I mean by that is, you saw in the former chart, if you hold a high yield bond, you did really well. These excess returns adjust for the credit risk and say, did it do well, accounting for the fact that it was below investment grade? And in actual fact, relative to the market, not always. And so with these risk adjusted returns, so rates were higher. We had a little bit of an overweight in a certain part of the curve, in the intermediate part of the curve in February. We're a little underweight overall, and so that was sort of offsetting, and there was a net negative. Coming down a column, this portfolio does have a little bit of currency exposure. And recently, with better expected growth in the U.S., and certain emerging market currencies already having high inflation, reducing rates, some emerging market currency has underperformed. These are very small positions, but being overweight the dollar a little bit, as you see here, added 15 basis points. And then what the next line does is just look at what's your market exposure. Often market exposure is embedded in all the risk securities you're buying, corporate bonds, high yield. We're extracting that and saying, what is the market directional risk of the portfolio relative to a generic market? And so that was 85 basis points, and that just reflects how well credit has been doing. The next is, were the sectors better than picking a generic market index? And you'll see here, mortgages, we did have a little of agency mortgage exposure relative to nothing in a benchmark, and so that was a detractor. As you saw, it had negative excess returns. And then the other sectors all well, not all, most did well, and so we do have non-agency CMBS, CLOs, some emerging market exposure, and the high yield is negative, and that's why I went through that little explanation before, because on a risk-adjusted basis, it underperformed the generic market, even though it had a positive excess returns, and we did have some high yield exposure here. And then the next section just tries to say, well, you bought those sectors, but were the issuers, the bonds that you bought, outperforming those specific sectors? And so getting into a little bit of detail here, one nice thing about a portfolio like this is you're buying securities across maturity spectrum, buying 5s, 10s, 30 years, but you're telling us you don't want really very much duration because you picked a portfolio with 3-month Treasury benchmark. So what we do is we hedge it back with futures. Generically speaking, over time, being short futures is an advantage. And so in this period, it added 22 basis points. And then a few highlights from some of the other lines. Non-agency CMBS, so you hear all sorts of, or read, I should say, all sorts of scary headlines about commercial mortgages and empty office buildings. If you're very high in what we call the capital structure or AAA securities, and you don't have very short bonds that are risk of being extended, you can still have nice performance, and so there's some excess return there. CLOs have done well. Investment-grade corporates. The industry concentration in our portfolio has been U.S. money center banks, who continue to take advantage of strict capital guideline rules, diversified businesses, at least not the regionals, but the U.S. money center banks like Goldman, B of A, Morgan Stanley have continued to perform well. And we actually have an energy overweight in the portfolio as well. So midstream, downstream energy is something that we've liked for quite some time. More conservative, capital efficient, also benefiting from decent energy prices. And so those firms, those industries have done well. A little bit lower, high yield security selection has been positive. And so there's been a rebound in some consumer, home construction, independent energy, meaning more power. Those have all contributed to the portfolio. And that's really the highlights I would mention now. And so that all contributed to outperforming that risk-free benchmark by over 1.5%. That was a lot, so maybe I'll just pause there to see if there are any questions on anything.
I guess we're good. Oh,
Okay.
Maybe Randy.
Oh.
Are they? And why
Yeah,
could we have
so
them?
post-financial crisis, so going way back to 08, 09, and actually I don't even remember exactly when. It was a few years later, like 10, 11. There was a program in place where there was financing available for municipalities, states, to raise money for infrastructure and things like that, and that was the predominant municipal bond issuance in the taxable fixed income market space. Generically speaking, they were high quality, maybe some single A, but mostly double A, and 30 years. And we found them generically attractive relative to corporate credit. Not only did they have wider spreads relative to corporates, and a little bit of that is a little bit of liquidity premium, maybe they're a little less liquid, their issuances are smaller. And so we bought as many as we could. Over the years, that has gone away, and the predominant municipal issuance right now is intaxable. Just be specific, these are taxable bonds. For universities and healthcare, but even that is declining. Fiscal positions of states are better than they had been in the past few years. And so now municipals in general are less liquid and hard to buy, and actually not as attractive. The lack of supply has caused the spreads to tighten, and so there's a lot of demand there. And so the portfolio has less munis than I think we've ever had.
Thank you.
Sure. And then just moving on, I'll skip the painful details in the next few pages and go right to page 18. And this is the portfolio, so that familiar bar chart of exposure. So you'll see right up top, effective duration of the portfolio is 0.2, so only 0.2 of a year relative to that 3-month Treasury. And the view is that rates will be fairly stable in this range. Just modest underweight. And I would say over time, this is a point in time, it's been fairly close to the benchmark. On the left-hand side are where we have sector exposure, and here you have where it was at the end of April and where it was at the beginning of the year. Remember, it's not relative to the benchmark now because the benchmark doesn't have any of these securities in it except for the treasuries, which should be 100%. So we like agency mortgages. We do have a 5% exposure. Investment-grade corporates, there's been a lot of issuance, but then there's been net supply has been lower than it was because there's been a lot of maturing bonds as well. We like that market, but there are some sectors of the fixed income market that are a little bit more attractive. For instance, securitized is a bit cheaper. And so we own some CMBS exposures. I was mentioning those intermediate tranches. Really like AAA CLOs. A little bit of asset backs. The consumer and business has deteriorating credit, but there are some better issuers with some better collateral. As I was mentioning, munis, it's a tough sector recently. This portfolio does own below investment grade. A little bit of bank loans, we've reduced that, and we've reduced emerging market, but we do have that. One of the richest part of the markets, I think, we believe is sort of investment grade or EM. It's for the rating, it's not as attractive as, say, U.S. credit or other types of developed market credits, but some below investment grade sovereigns there. And that cash equivalence, which is quite large, does include securities that you may not consider cash equivalents. Our definition is any security that is A or above, that's 1 year or less, or any security if it's a sovereign. And so there are securities that you could put in the other sectors that are considered cash just because they're really short. So I don't want you to think we're just holding a bunch of money market. In general, this risk has sort of two aspects if you're comparing it to Core Plus. One, much less interest rate risk because the duration is 0.2 instead of 6, but more credit risk, and so that does offset it. And you can see that on the right-hand side where a portfolio like this has about 17% below investment grade securities. And so this portfolio is meant to be more credit risk, less duration risk. Any questions there? Okay.
We're good, we're good.
And so lastly, there's a bit of an outlook. I haven't actually counted. There's probably 50 pages there. So I'll spare you and just go through 4. First one, 25. Just big picture. And you've already heard the outlook from the last presenters. Ours are perhaps not that much different, but just sort of to lay it out there. I mentioned our expectation is rates are in a range. We do believe we're in a different environment, and I think this picture sort of says it nicely. We went through a period of artificially low rates from a historical basis. They were appropriate for the time. If you think about really low inflation, really low real rates, 0 or negative at one point, but it's a different environment. Inflation is expected to be a little bit higher, a little bit more persistent. Real rates are likely to remain higher, maybe just a little bit below growth. And then what we call term premium, or the additional basis points you get for going out the curve, there will probably be a little bit higher as well because of all this government issuance that doesn't seem like it will likely stop in the near future. So our expectations are rates are higher a little bit in a range and not likely to return to where they were in that sort of last red section. So that's sort of very important backdrop. Number 2 is page 31, and just what are growth expectations? And so universally, to a fault, it seemed that all the money managers and all economists had a very high expectation of a recession this time last year. And that turned out not to be true. And that's why we're sitting at over 5% in federal funds and higher rates, and we have more inflation. Growth was just much better. And so if you look at the outlook and go to that yellowish bar for 2024, you'll see it's 2.4%, which is considered a little bit above potential. If you have 1% productivity and 1% population growth, and you're coming to something like a 2% expectation for growth, it's a little bit better in the near term. And so the fundamentals are pretty good strong. There are those caveats that were mentioned before, like weakening consumer credit. But generally speaking, the economy continues to do better than expected. And that is really going on globally. You had a Northern European recession, if you will, although a slight one, and you had the Southern European partners offsetting that. But European growth lower, but still better than was expected, given the headwinds they're facing. Japan, talks about their sort of bouncing out of their doldrums that they've been in the last 30 years. And China eking it out. Tons of problems with property and perhaps mismanagement from the government with overstimulation of different sectors. But it seems like in the near term, at least, we think they'll be able to at least maybe not hit their target of 5% or have 4.5%. So generally speaking, backdrop of fundamental is decent. And you're seeing that recognized in the marketplace with high prices. The third fundamental would be inflation. And so we've had some favorable inflation statistics. It has been stickier or not declining as much as, say, the Fed or many economists or all of us would hope. And page 42 just points to why. And it's, persistent services inflation. And you'll see that in the dark blue on the left-hand side. And so, core goods have come down, other aspects of inflation. It is expected to decline by us by the end of the year, but not at a particularly rapid pace. And so that probably leaves the Fed room to ease one time at the end of the year. But that's the reason why it'll be a little bit sticky, and we still have some wage pressure. And so inflation staying where it is, that's a contributor to sort of rates staying where they are. And then the last point, this page, I should put my glasses on, 56. So that sounds okay, but valuations are reflecting anything good that I've said. And so this is a picture of spreads in investment-grade corporates and high yield relative to treasuries. And so you get paid an additional amount of basis points to be invested in these, and this is representing how much more. The charts are adjusted for the change in quality and maturity over time. And you can see historically they're quite tight. It's reflecting a favorable environment. And so valuations aren't quite what they were. They're somewhat rich. It doesn't mean there aren't issues, issuers, sectors that are more attractive. There's some dispersion, so there are good investments to find. But generically speaking, it's cause to be cautious. And that's why we have less risk in this portfolio than we historically had. Questions?
Okay. Any questions? Okay.
Okay. Thank you very much.
We sure appreciate you coming in.
Thanks.
Thank you very much.
Thank you.
Thank you. Okay. Is that gonna? Okay, so we're gonna move on to item 4, which is our consent docket, which we can take with one vote. I'd just like to mention real quickly, item A, that Mr. Dowler has been reelected. If you remember, he filled out the remainder of Marty Lawson's term, and he's been elected to serve a full 3-year term. So congratulations, Doug. Glad to have you. So Chair will entertain a motion on item 4. Have a motion and a second. Please record your vote. Item is approved. Item number 5 is to ratify approvals. We have one item. Have a motion and a second. Please record your vote. Item is approved. Item number 6 is to approve the claims docket. We have a motion and a second. Please record your vote. Item is approved. Item number 7 is to approve the following applications for service retirement. We have several. A motion and a second. Please record your vote. Item is approved. Item 8 is to receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. Have a motion and a second. Please record your vote. Item is approved. Item 9 is receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. Have a motion and a second. Please record your vote. Item is approved. Item 10, receive report of death, authorize secretary to make necessary changes to conform on the following. Have a motion and a second. Please record your vote. Item is approved. Item 11 is items for individual consideration. Item 11A is the agreement between the retirement system and the city regarding the city's obligation to provide professional and non-professional services and office rental to the city. This is our fee for the period of July 1, 24 through June 30th of 25. Do you have any questions on item A? Chair will entertain a motion. Have a motion and a second. Please record your vote. Item is approved. Item B is the Administrative Services Agreement with the City Deferred Compensation Board and the City of Oklahoma City to provide administration of the 457 and the 401 plans for the period of July 1, 24 through June 30th, 25. Any questions on item B? Hearing none, Chair will entertain a motion. Have a motion and a second. Please record your vote. Item is approved. Item C is to approve the Oklahoma City Employee Retirement System budget for FY 24-25. Do we have any questions on item C? Hearing none, Chair will entertain a motion. Have a motion and a second. Please record your vote. Item is approved. Item D is a resolution to ratify the chairman signing a most favored nation elections on May 28th, 24 on behalf of the ERS and authorizing execution of similar ministerial documents in the future to preserve rights of the Oklahoma City Employee Retirement System. Do we have any questions? Hearing none, Chair will entertain a motion. Have a motion and a second. Please record your vote. Item is approved. And finally, item E is approved purchase of JitBit ticket management software with an estimated annual cost of $2,500. Any questions on item E? Hearing none, Chair will entertain a motion. Have a motion and a second. Please record your vote. Item is approved. Okay. Item 12 is to receive the investment consultant report.
Hello again. I'll try to talk into this. I'm probably not very good at that.
Do your best.
I'll do my best.
Do
I'm
your
always
best.
looking up. If you'd go to the next page, or next one more. So you heard from the two of your fixed income managers this morning. In addition to those two, we have a core pure index-based manager in the SSGA index, and then Brandywine, which focuses more on global bonds to round out the diversification within fixed income. As I mentioned earlier, We did, at the beginning of this year, make some modifications to the strategic asset allocation, decreasing equity overall from 65 to 60, and increasing fixed income target from 20 to 25. Within equities, long-short equity is going to zero, and those funds will be moving to fixed income. And really what we've seen, is, as you heard from these two managers this morning, expectations because of higher yields for fixed income are better than they've been really in 15 years. So for a pension fund that needs 7% return over time, when yields were at 0 to 1%, it was much more difficult to have a significant allocation there. Today, with yields at a higher starting point, it's more attractive. This couple things to point out on this chart, you'll see in the bullets at the top. Of course, this is for the end of May. May was a good month for equity markets following a downturn in April. As April, we had, worse, stickier inflation numbers coming out that were higher than expected. In May, core CPI year over year met expectations. Actually, it fell from 3.8 to 3.6. And then just yesterday, the June CPI number year over year, so one more month, fell to 3.3% year over year. And we saw the NASDAQ and the S&P 500 break the all-time records that were set the day before on expectations that those numbers would come in good. Again, this morning, PPI, Producer Price Index, as well as some jobs data came in. I don't know how to, I can't say it's better than expected, I guess worse than expected. Fewer job or more job openings, and the inflation number came down a bit. So the expectations based on Fed comments yesterday are still that maybe one cut before the end of the year. I'm not really sure that that's something for long-term investors to be focused on, although it is certainly moving the markets from day to day. And as you see there on the left side of the page, these are year-to-date returns. The S&P 500, or large-cap U.S. stocks, continue to be the best performing asset class. It is seemingly getting a little bit long in the tooth, this rally we've seen in large cap and particularly growth. I just jotted down some numbers through yesterday and really focusing on the 10-year returns just to give you some perspective. As we look at your total portfolio, absolute returns have been good. Relative returns, as we've talked each month, have been challenged because if you, at the total portfolio level, diversification outside of anything large cap and growth has been a headwind. And even at the individual manager level, if managers are focused down in smaller cap names, that's been a headwind, and anything outside of really mega growth has been a headwind. For the 10-year return for the S&P 500 through yesterday, annualized, is 12.95%. The 10-year return for the ag or bonds is 1.4%, so about 11% difference between U.S. large cap and bonds. Not surprising, as we started out by saying yields were very low as we sat here 10 years ago. What may be surprising, small cap stocks on a 10-year basis, a decent return, probably in line with what our capital market assumption was 10 years ago, 7.3%. That's still 5% lower than large cap. That certainly would not have been expected. International developed stocks, 4.6% annualized over the last 10 years. We've had a very strong dollar. Their fixed income managers didn't get into that too much, but that's been a headwind for anything outside of U.S. and particularly large cap. Emerging market stocks the last decade up 2.5%. Now, large cap is your largest allocation in your portfolio, so you've benefited from that. That said, as you know, the representation of that S&P 500 in your policy index, what we measure against, it represents 35% of your policy index. and we're doing things within your portfolio that aren't large cap, long short equity, private equity in particular, and that's been a headwind. As you look at the middle of the page, this is the stoplight chart. This isn't intended to be a tactical tool to say get in or get out of things, but it is just gives us a sense of valuations relative to historical. Are things expensive or are things looking reasonably priced? And not surprisingly, large cap US from a valuation standpoint is well above historical averages again. US small cap, international developed and emerging markets all look to be fairly valued. So they're, and in some pockets, if we looked at value stocks outside of growth, probably more attractive. And as we look at managers, active managers are still not, your active managers aren't just looking for value or things that are priced cheaply, but probably avoiding things that are very expensive today. And so from a relative return standpoint, that's been a bit challenging. Cash and core bonds continue to look attractive because of higher yields. As we look at your portfolio, if we just go to the next page, from an asset allocation standpoint, as I mentioned, long-short equity, you see the $50.8 million, about 5.8% of your portfolio. We anticipate getting the first tranches of that back in the month of July. It's anticipated we'll get about $24.2 million back in the month of July. We'll work with staff to see what's needed for cash needs for probably the next quarter, but it's not going to be anywhere close to that, and we'll reallocate what we can into the fixed income strategies as that money comes back. So that's really the difference between the new targets and the actual allocation. Real estate overall a little bit underweight. The target of 15%, that's been a positive, as real estate's been the worst performing broad asset class in the portfolio. A lot of challenges, particularly in the office market, although your manager, Morgan Stanley Prime Property Fund in particular, significant underweight to office, overweight to industrial and multifamily, which is, they're still down, but it's helped that performance, certainly. Just going to the next page, looking at total fund performance for the trailing 1 year. As I mentioned, on an absolute basis, well ahead of your 7% target rate of return, but trailing the policy index on a net of fee basis by a little over 1.3%. You're up 11.1 net of fees, policy index up 12.5. Look down here. Large cap in line, that is your passive within large cap over the last year. You look at the 3-year number, and large cap is trailing a bit. We have made changes there. That was the Intex strategy, which tended to, while it was a large cap benchmark risk-controlled strategy, the way that it was implemented tended to overweight smaller cap names in the large cap benchmark. That's impacting that 3-year number for your large cap allocation. Small cap, a very good absolute return, trailing the broad market. We talked about this a couple months ago. We had Silvercrest and Earnest in, particularly Silvercrest on the growth side. They own significantly smaller names. We're comparing this to a small to mid-cap benchmark. The more mid-cap names you have, larger cap is doing better. Silvercrest historically, and our thesis around them is that they're going to own, and we want them to own, smaller cap names, and that was a headwind over the last year. But longer term, we don't have concerns there. The two biggest headwinds relative to that policy index, as I've mentioned, are long-short equity, which is going away, and private equity. That said, you'll see your private equity 1-year return, it's turning around from where it was flat. Now we're starting to see marks coming in for actually year end, 12/31/23. We're seeing some distribution activity and companies being marked up. We expect to see that to continue over the next, there's a pretty significant lag. One of your more recent investments in Sawmill, they already have marked that portfolio up to 2 times your money that you've put in, and you've put in they've made 3 investments in one platform company to date. So we're starting to see that coming through into the numbers, and over time, we'll expect that differential between private equity and large cap to close. As you see over a 10-year period, your private equity is up 14.4% relative to the public markets, large cap up 12.7%. So over time, certainly adding the value we would expect. International, similar story there. It's a good absolute return, up 14%, trailing the benchmark. Once again, we're a little bit smaller cap oriented within international currently. The Harding Loevner strategy, a much lower exposure to Japan. Lower quality stocks in Japan rallied significantly toward the end of the year, and that wasn't in their portfolio. We'll have the 2 international managers are coming in, I believe, September and October, and then next month we have Brandywine, and we will have seen all of your managers by that point. At this time, no specific manager issues or concerns. We'll continue to work on the rebalancing of the portfolio as these funds come back from your long-short equity portfolio over the coming months.
Okay. Any questions for Jason this morning? Okay. Thank you, sir. Another great job. Okay, moving right along. We are on, I'm sorry. Chair will entertain a motion on item 12 to receive the investment consultant report. A motion and a second. Please record your vote. Item is approved. Item 13 is comments from board staff and citizens. I assume everybody got an email from the Oklahoma teachers retirement system regarding the trustee education conference. I don't know if everyone got one. I assume the folks that attended last year are on the list. They may have got one, but that's going to be in Tulsa this year, the end of September as usual. So if you didn't get the email, let me know and I'll forward it to you. Secondly, I announced last month that we had hired our deferred comp specialist in the office, Angel Odom. Angel's here today. Everybody say hi. She works real closely with Matt, who is the chairman of the deferred comp board. So glad to have you. You know that already. So.
Paul, on the conference this fall, do we let Gina know if we want to attend, or do we go ahead and make the reservation ourselves?
It said in the email that you could either register on your own, or you could do it as a group.
Okay.
Did you get it?
I got an email,
You
yeah.
got the email,
Yeah,
okay. I think it said you could do it on your own, and there was a link, or we could do it as a group.
If everybody wants to just let me know, I can do a group.
Okay. Okay.
Okay.
Yeah.
So we'll just send you an email if we wanted to. Okay. Will do.
Okay. Any other comments this fine morning? All right, hearing none, we are adjourned at 11:09. Thank you, everyone.